Hi, this is Sive Morten with the daily update on EuroFX. I post my exclusive market overviews with the key political and economical events, charts, and important levels on the ForexPeaceArmy.com forums weekly. This short video is a response to rapidly changing situation on the currency markets and should help you to stay on top of the game and be profitable. I suggest you to visit ForexPeaceArmy.com forum and read my analysis for the week before watching this daily video.
Welcome back, everybody. Let's take a look again on the gold market. In general, overall situation on the gold market remains tricky, not only in the short-term trading that we discussed on Friday, but in general, overall background stands, well, it's a bit fragile. So we, in the weekly report today, trying to find out what's going on and what's the real drivers and what factors stands behind the gold shape and gold market performance. And it's a bit, well, in general sentiment on the market stands not very positive. So we see the drop of the reserves on a major fund. I mean, SPDR fund doesn't support the overall performance on the gold market and looks hairy. So currently, storage stands on the lowest level within the few months. The sentiment on the market also stands tricky because we see some change in the positive net position. So it's rising, but it's rising on the background of the dropping of the open interest. And with the long-term bearish view on the market that we have, we suggest that in the shorter term, in perspective on a few months, gold could show some upward performance, but this performance will be really fragile and not stable and could be breaking in any moment, because mostly this performance will stand because of the problems in the supply chain that stands across the globe currently, because of the new variant of the virus, some problems in the cargo transportation, especially in the seaway stands right now. So, due to the flood in a different part of the world, especially in the Germany, as you heard probably about that. So, in China, of course. So, that could hurt the chain supply in the short-term perspective. Additionally, despite that we're expecting the Fed policy change, the Fed still keep buying bonds from the market, controlling the interest rates, keeping the interest rates under pressure, and keeping the real interest rates in the negative territory, which makes it different what to care, either bonds or the gold. So this is supportive to the gold. Additionally, with the all supportive measures from the government, I mean fiscal measures, stimulus, and so on, that creates the background that in general might be supportive to the gold in a very short-term perspective, especially, as I said, the problems with the supply of some goods, especially for the automakers, semiconductors, as you know, some problems exist with that as well. That could lead to some deteriorating of the statistics in the short term. The markets and the sentiment of the investors, the sentiment of the consumers, production, and some other statistics could be hurt by these temporal problems. And that might be supportive to the gold in the short term. So in the shorter term, gold has chances to show some upward action, but we do not expect that it will be too strong. So Commerce Bank, for instance, suggests it might be back to the 2000 level. I'm not sure about that, so I would suggest that maybe we could climb to the 1875, 19 even, or slightly higher maybe, but not very significant. So I think that the bearish context will take the dominant sooner rather than later. So let's go back to the shorter term situation. Here we said on Friday that overall performance makes us think that the upward action that we have here is not over yet. So initially we thought that it might be minor retracement back to this 50% level, and it should be downside continuation with this leg. So some kind of the ABCD might be starting. But the performance that we see in the recent 2 weeks here makes us think that we should get another upward bounce. So a kind of garlic triple to sell pattern on a daily chart. before the major collapse will start. And the most tricky moment here is how far the upper direction could reach. Personally, I prefer to focus on the nearest standing target first and then see what will happen. And the nearest standing target stands at the COP around 1840. This is a good target because it could be reached. It stands below the daily average, but it stands, well, right in between of the 50% level 618, so mostly it agrees with them somewhere, creating the resistance area. And what is another advantage of the COP, this is enough target to complete the grabbers that we've got here. So on Thursday we have the grabber, and that was the source of our confusing, because by a few reasons, as you remember, we discussed this on Friday. But as we said, why we can't get another pattern on Friday if even market will show the new lows? And that has happened. So actually, guys, take a look. Here we've got another grabber. So we have the two of them right in a row. Both of them suggest, or you could use just a recent one, it's no difference, has the same target. Market should take it out to the top. And it means that we could get some ABC action. Why I'm also talking about the COP, because actually forming the COP, it also will be the catalyst cheaper to sell. It's not necessary to the market to complete the OP, but if market will create any of the ABCD pattern, that's also catalyst cheaper to sell. So currently I am focusing on the COP target. OP, it's also acceptable for the bearish scenario just because we have the huge triangle is forming on the weekly chart. So if you will read the report, you will see it. And the OP agrees with the upper border of this pattern. It is not very good reaching the OP from the perspective of the monthly engulfing pattern, just because it will be too much action to the upside. Market will break, in this case, 618 level, climbing even to the 786 resistance minor fib level. So reaching the OP at 1872. But from the perspective of the huge triangle, this is acceptable as market will stay inside of it. And if reversal will start right from here, starting dropping, that will be okay, but not as pleasant as if market will turn down, say, from the 1850, for instance. That's what about situation on the daily chart. Now let's try to find out what to do with the current performance here and on the intraday charts. If you remember, the major concern that we have is that on Friday, market has formed the bullish grabber, but it hasn't completed the OP target. It's 1785. And it was the risk that market could show the performance that it has shown, actually. That market could try to complete the OP, despite that overall context for reversal might be valid. And that's the reason why we said that if you could consider taking the long position here, of course you could focus on some minor pattern on the intraday charts. In particular speaking, that was the hand shoulders, if you remember. But it would be better to place initial stop below 1780. If you can't carry this burden with this too far stop here, it would be better to follow the conservative approach and wait when the OP will be reached, or we will get clear signs that market is turning up. As a result of this choppy action on Friday, as you can see, with a few spikes down, we've got another grabbers have been formed now on the follow time frame chart. And it confirms our theory that indeed market could starting upward action, because you can see that every selling here is buying out by the stepping in of the buyers. So this suggested by this really huge tails to the downside. So with this spike down on Friday, market stands very close to the OP target. It hasn't been completed totally, but well, it's very clear. We're very close. So what we could do in the current circumstances? Mostly the setup that we discussed stands the same. It tells that in the range of these grabbers, which is a daily or 4-hour time frame chart, they're mostly the same, we could consider taking the long position somewhere in this range. In what point you prefer to take the position, you could decide by yourself. I will show you the one example on the hourly chart that maybe will work, maybe not, but at least it could be considered. But anyway, currently at the first moment, it would be better to place stops below 1780 by the same reasons, because what performance market will show here, especially on the Fed meeting, What the volatility will happen around it, we do not know. It's an additional risk from the Fed. This could bring a lot of volatility here as well. Speaking about the bearish context, we have to see the breakout of this level and erasing of all bullish patterns that we have. For this purpose, we need just to see the breakout down with this level. In this case, all bullish context will be erased, and we start to talk about the bearish position. Because in this case, it might happen indeed that market starts action with this downside X or major extension starting. Also, from the Judd Napoli approach, here we have kind of the oops directional pattern is forming. Here we have definitely strong support cluster, especially this confluence, and it stands right around the neckline of the hand and shoulders pattern that we discussed. That prevents market to complete the target of the hand and shoulders and pushing up again above the neckline, which causes an oops directional pattern. Directional pattern suggests some upward bounce here or starting some extension to the upside. So it's breaking normal performance of the market. And that's why it calls it the directional and the directional overrules trends, by the Judd Napoli framework. So on the hourly chart, as I said, it's a possible scenario. So currently you could see definitely that we don't have any hand shoulders. So we were starting our discussion on Friday right at this moment. This market shows upward action, and we said, well, hand shoulders might be forming. But later, as you can see, it has failed. And currently we clearly see that this widening consolidation is forming. Usually, the market follows the direction of the breakout. So widening and consolidation has no direction. And if market breaks it up, it means that it will go up. If it will break it down, so you understand. So, but taking in consideration of all our scenario that we just have discussed, and we're considering taking the long position, one of the setups that you could consider, for instance, in forming some patterns inside of this consolidation. For example, if market will show some ABCD minor retracement here, complete the OP around 70.95, that will be minor, Gardner's cheaper to buy, and right in agreement with the 618 support. That will be at least something that you could try to use for entry. Also, we have the bullish growing divergence on the MA city, as you can see on the upward chart as well, around major support on the follow time frame chart. So that's the general logic that you could follow with making the decisions, how you could consider possible entry here. So that's approximately things that we intend to keep an eye on the gold market on the next week.